Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
This is Mike Gleason with Money Metals Exchange, and it is my privilege now to be joined by Frank Holmes, CEO and Chief Investment Officer at U.S. Global Investors. In 2006, Mr. Holmes was named Mining Fund Manager of the Year by the Mining Journal. He is the co-author of the book, The Gold Watcher, Demystifying Gold Investing, and is a regular guest on CNBC, Bloomberg, and Fox Business. And you can find his company, as well as his renowned Frank Talk blog, at usfunds.com. Frank, it's good to have you back on. Thanks for joining us again.
It's great to be talking with you and your followers.
Well, to start out here, Frank, we saw some really positive price action for the metals in October, but they've been slumping again this past week. This market just can't seem to sustain any real upside momentum. What's going on here?
Well, I think what happened was with the Fed was the thought that Fed's 50% probability they're going to raise rates in December now, and the 10-year government bond. It's so important for gold investors to monitor and track what the 10-year government bond is doing. And the yield was almost 2.6 a couple months ago. It fell down to approximately 2%, and now it's 2.25. So we've had an 8% rise in the 10-year government yield in basis points. It's so de minimis, but it does have a very significant inverse relationship to gold prices. So that yield rising immediately starts to push gold down.
You mentioned the Fed there. Once again, we seem to have Fed watchers putting a tremendous amount of stock into the rhetoric rather than the actual policy decisions. Are you surprised that despite not having raised rates in more than, 9 years now, markets still get spooked at every hint at an interest rate hike? Because to me, it's astounding that commodities, especially gold and silver, are acting as if we're seeing hawkish policy coming from our nation's central bank, but that's not the case at all. It all seems to be talk. What are your thoughts there?
Well, I do agree with this thing on talk, and what people don't realize is the whole argument of form over substance. That thought process is so often used for fraud when someone made a commitment for some substance, but the form looked good, but it fell apart. But the same thing happens in investments, and a lot of times it's not so much that it's fraud, is that people say one thing, and underneath that substance, that tip of the iceberg you hear and see, but really underneath it is a substance of something else. And what has happened with that was zero interest rates, the Fed funds being zero, and everyone focuses on what's called nominal rates. And then the Fed funds are zero, so therefore that's what everyone focuses on. And they're going to raise rates by 25 basis points. That's the nominal rate. What's been more significant to the action of gold is real interest rates. That is, what will the government pay you on a 10-year government bond minus the monthly CPI number? And that is much more significant, and all the research we've done with gold prices are the interest rate differentials on the real after inflation coupon the government's going to pay. So when we look back at the peak in 2011, in September of 2011, for the price of gold at $1,900, the 10-year government bond had a minus 3% yield. So you took whatever they're paying you, took away the inflationary rate, and you're losing money. So why would anyone buy that? And that was the reason for gold to hit that 1900. And then real interest rates on 10-year government bond went from 1% to 2% to 2.6%. So we went from minus 3%. Inflation was higher back in September 2011. So the inflation fell to very low levels, and the interest rate rose. So all of a sudden, you had positive real interest rates swing up 550 basis points. And any time that's happened, commodities take it on the chin, and so do emerging markets, and the dollar soars. So what you get out of that is a crisis, and then they start a reversal. So based on looking back out of 30 years of data, the math, the odds favor that the dollar will be weaker, that real rates will not be as positive, and gold will rebound along with the emerging markets.
Obviously, a lot of what's going on here in the commodities, as you mentioned, is a strong dollar generally equals weak commodities since they are priced in dollars. We do have a strong dollar relative to these other fiat currencies around the world. I guess Mario Draghi again talking about some more stimulus measures, quantitative easing measures there in the Eurozone. Do you expect a reversal to this strong dollar trade that has really dominated the currency markets that's been weighing on gold and silver? Do you expect a reversal there, maybe?
I think that your question has to go for the Fed. They don't care about gold, except for its money. They do care about that as a sound money, because they don't keep these other countries' currencies. They only keep gold. That's the only thing they trust. I think what is more important is that when you're looking at all these press releases of S&P 500 companies lamenting about their pains of strong dollar and they can't export, or their product doesn't matter if it's Tiffany's or it's Caterpillar. There's this concern that the strong dollar is shaving off a lot of earnings. And I think that that's more significant for Fed making decisions. And I think that for investors, what's important when we look at, and I've written about it many times, is better to focus on what's called PMI, which is Purchasing Manufacturers Index, because it's forward-looking and it recalibrates its data every month. When people look at GDP, and metaphorically, it's like looking out your rearview mirror. It's what's behind you. But when you're driving, you can't stare out the rearview mirror. You can check it before you switch lanes, but you have to stare where you're going, and that's going forward. And the PMI is a great tool to try to measure the temperature of going forward, and it's highly correlated to the commodity demand. So what was really bullish this week that I thought came out was getting ready for the big liftoff is that global PMIs turned positive. China turned positive. America's positive. Europe is positive. And when you get global PMI turn positive, the math suggests that in the next 3 months and 6 months, you'll see rising commodity prices, in particular for copper, gold, and oil. One of the big key factors for a huge liftoff will be when China gets above 50. The other countries, as I mentioned, economic power bases like the EU, is that they're above 50, and then 1 month is above the 3 months, so that's a much stronger positive stance. But when China gets above 50, the commodity demand picks up exceptionally. So I think that we're going to see next year as an election year in America. I think odds of them lifting interest rates going into election year are slim. And I think that global PMIs look like they've troughed if you look at cycles. And so with that, I think we'll see a bottom in the mining industry this year in mining stocks, and we'll probably see commodity prices firmer next year.
Continuing there on the mining sector, you're down in Peru as we speak at a mining conference. What's the state of the mining industry right now? You obviously follow that as closely as anyone, having been honored in the past by those who rank sector analysts like yourself. What are you seeing there, and have we maybe seen a bottoming in the miners?
Yeah, I think there's a very cautious bottom. I think the exploration is going to change. I think that it's going to be very difficult to raise capital for exploration. So as the world continues to have babies, this thing of getting reserves to fulfill and metals, etc., is going to be much more expensive. And I think the environmental costs, the social, they call it social license, all these things are costing a lot more money. And I think that in the next 10 years, we'll see huge changes in the commodity prices because we're going to get supply restrictions. Now, when we look back over the past 15 years, there's been $1 trillion spent on mining, $1 trillion. And what's interesting when you look at that macro, big, fat, juicy number is that you see that $300 billion went into iron ore and $300 billion went into coal, predominantly what they call metallurgical coal. And you need metallurgical coal with iron to make steel. So what do we have? A huge surplus for the next decade of iron ore and met coal. But only $150 billion was spent on copper, and $150 billion was spent on gold. And so there's much more, less supply for those metals in the next 10 years. And when we look at zinc and metals like that, there's even substantially less. So we could see a surge in zinc prices, a surge in some of these other base metals, but not iron, not coal, not met coal. So I think these are interesting aspects to take a look at. Peru is copper. Peru's currency correlates with the price of copper. So what's happened is that the price of copper has declined, so is the currency value. So the cost of paying local workers hasn't changed. It's set itself, so it wasn't a burden. If they had a stronger currency and the copper price fell, then they'd have a lot of pain. So what we are seeing in many of these countries is that the weaker currency is actually helping some of these countries and lower energy prices to produce their metals. That has also been a big benefit in their cash flow.
What's the general mood among the mining sector? You're down there. You mentioned that you were impressed with the turnout for those that came to this conference. What's everybody thinking there? What's the general mood among those in the industry?
They're looking for very selective opportunities, but they're looking. And there's money there sifting through, looking for opportunities. Much more rather what they call brownfields, where there's already a deposit. There's money to develop it, to bring it into production, grassroots exploration. There's no capital. I think it's important is that, the global recovery started. It doesn't go straight up every day, every month, but all the bears in beginning of October, it was an incredible month. When you take a look at what the S&P different sectors did, and the worst performing sector in the market was up as utilities, like less than 1%, but materials was up 9.98%. Huge surge. So I think that you found the bottom, and it'll settle in and get ready for the next turns.
The last time we had you on was back in the summer, and we were in the throes of some unprecedented buying in the physical bullion market. Now that seems to have abated in recent weeks finally, and we're getting back to more modest levels of retail interest. But given the seemingly unstable footing that we may be on right now in these economic markets and with Fed policy and currencies and so forth, do you foresee any events which could get things moving in the metals markets again, maybe something to bring back that fear trade you've been talking about?
Well, the fear trade is predominantly rapid money supply growth, which we're not getting. It's not taking off. When we look at emerging markets, in 2011, the seven most popular countries had money supply growth of 17%, compounded now, so 10%, so it's fallen 70% basically. So if you got that turning and you had real interest rates, so let's say the U.S. economy trips up and starts to slow down, then rates, the 10-year government bond falls and inflation starts to rise, then you'll get a spike in the price of gold. So really you got to follow real interest rates and the money supply to understand that fear trade. For the love trade, it's so important to see that China and India turn the corner, that their economies, in particular China, gets their PMI, the Purchasing Manufacturers Index, above 50 and maintains that the 1 month is ahead of the 3 months. That will create that big move, and it'll be a nice move. It won't be straight up and right away. It'll be gentle, but rising.
Well, Frank, as we begin to close here and let you get back to that conference, is there anything else that you would like to share with our audience here?
Yeah, I think the big part for them is to make sure that they have their balanced weighting. When we talk about stocks, we like stocks that have high cash flow returns on invested capital, growing their dividends. And in that whole universe, I've always recommended for individual stock that you buy, you look at the royalty companies because they have the strongest dividend growth of all the mining companies. And you have this balancing factor that you're 5% in bullion, 5% in gold stocks, and the other 90% is invested in good companies, short-term fixed income, and something like our short-term tax-free Nerex, which has had 20 years of positive performance. Only 25 out of 25,000 funds have delivered that very short-term stable yield, and you park your money looking for an opportunity to buy stocks.
Well, wonderful insights as usual, Frank. I know you're busy and you want to get back to that conference, so it was great talking to you again. We really appreciate your time, and we hope to catch up with you again down the road. Now, before we let you go, real quick, if you can tell our listeners a little bit more about your firm, your services, and what you've been working on recently on your fantastic Frank Talk blog.
Well, the biggest thing that was exciting for us so far this year was launching our first ETF. and that's JETS, Jets, and it's the airline industry. And when you look at Barron's, they wrote about twice as the most undervalued industry group of the S&P 500 when you look at cash flow multiples and growth in dividends. And it's a good hedge against falling oil prices. They benefit dramatically for it. It's the inverse. And so that's been exciting for us. But on Frank Talk, what's important for investors is our discipline of always looking back over last week and finding three strengths and weaknesses that impacted a category, such as China, or it could be resources, it could be gold, and then looking forward only 1 week, what would be an opportunity and a threat? Would be three opportunities and three threats that we could have occur, and it helps us to manage our expectations. And I think that that's really helpful and useful, and that's why we have 40,000 readers in 170 countries.
Well, yeah, very good stuff there, and enjoy the rest of the conference and safe travels as you head back. Thank you again.
All right. Happy investing. I'm off to Australia. I'm going to find out what's happening there.
All right.
Care.
Well, we'll catch up with you down the road. Well, that will do it for this week. Thanks again to Frank Holmes, CEO of U.S. Global Investors. The site is usfunds.com. Be sure to check out that and the previously mentioned Frank Talk blog, some of the best market commentary you'll run across anywhere. Again, you can find all that at usfunds.com. And check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.